Good morning. Good morning. This is an open meeting of the U.S. Securities and Exchange Commission on February 6, 2024. I want to welcome members of the public who may be listening and joining us remotely, and of course, those that have decided to join us in person here as well. Today, the Commission is going to consider one recommendation from staff with regard to an adoption of a final rule or a set of amendments, but whether to adopt new rules to further define the phrase that comes from the securities laws, quote, as a part of a regular business, and this end quote. And that's used as part of the statutory definitions of the terms dealer and government securities dealer under the Securities and Exchange Act of 1934. It's in connection with certain liquidity providers, such as those in the U.S. Treasury markets. I look forward to the discussion, the recommendation from the staff. I think that what the Commission is considering here today, whether to adopt this final rule of further defining dealer and government security dealer, is quite important. I'm pleased to support the adoption because it requires that firms that act like dealers register with the Commission as dealers, thereby protecting investors as well as promoting the market integrity, resiliency, and transparency of the markets. At the core of the securities laws, all the way back from 1934, 90 years ago, registration, oversight, and the regulatory regime for dealers has been a cornerstone of these laws. It was really amongst one of the first authorities that Congress gave the newly set up SEC in 1934. Now, why is that? It's because when dealers register, they become subject to a variety of important laws and rules that help protect the public, promote market integrity, and facilitate capital formation, our three-part mission. Amongst the things that they need to do is have a minimum amount of capital, reporting in terms of their books and records, and data that they report to the regulators. This regime benefits investors and issuers and markets alike, and as I've said, it's been in place for nearly 90 years. Congress, though, in crafting those 1930s laws, those foundational laws, actually exempted Treasury securities and thus government securities dealers from these key provisions. Well, this all changed in the 1980s in response to a dozen firms in the Treasury markets that had failed between 1982 and 1985. I actually recall this vividly, so it's a little bit of a personal story, I'm going to say, but one of these firms, Drysdale Securities, failed in the spring of 1982. I was in my second or third year at a big Wall Street firm at the time. I was not on the trading side. I was on the investment banking side. But as a young associate on Wall Street, and again, though I worked in the mergers and acquisition area at the time, again, far from the trading floor, meaning 3 floors away or 4 floors away, the news spread pretty quickly that Drysdale was failing in May of 1982, and none of us had heard of it. Who were they was kind of the thing. They weren't Salomon Brothers. They weren't Morgan Stanley. They weren't kind of the big banks, the Chase Manhattan banks and so forth. I remember as my colleagues and I processed what had happened, as well as the potential effect on the markets and potentially the economy. Drysdale, which was not actually registered or regulated as a dealer, had significant involvement in the Treasury markets. It also had a lot of leverage. Now, these are the numbers from back then. It's 40 years ago. They might seem smallish, but they're just still remarkable for its time. The firm only had purportedly $30 million of capital. Now, subsequently, in the lawsuits brought by various individuals and the government and the SEC at that time, they found out that they didn't really even have the $30 million of capital. But purportedly, they had this $30 million of capital, and they had a portfolio of about $4 billion. You can kind of do the math about the leverage in that circumstance. In the ensuing years, from 82 to 85, it seemed like every couple of months, another government securities firm would fail. unregulated government securities firms collapsing. ESM government securities was another one I vaguely remember, but I do distinctly remember the Drysdale one, none of which were regulated as securities dealers. So in response, President Reagan and Congress came together in 1986. Now, I do not recall this. I was not watching what government was doing in 1986. I was getting married. But that year, President Reagan signed Government Securities Act into law. Chair Shad would have been sort of advocating for it in Congress. This was a gap in the system at the time. And the act granted the SEC and other regulators, importantly the U.S. Department of Treasury, authorities to regulate dealers and brokers in this space. It also gave us the initial authority to oversee Treasury clearing at that time. And so working with the SEC, the U.S. Department of Treasury put in place rules for government securities dealers as Congress directed. Yet some nearly 35 years later, when I arrived in 2021 at the SEC, I was told that though numerous firms had registered with the SEC, numerous firms trading and providing dealer functions as Congress had laid out as a regular business, had registered as government securities dealers. Some market participants had not. I think that leaves a potential regulatory gap and risk in the system. The markets also have evolved in other ways, such as the sort of digital trading or electronification of the markets, the use of algorithmic trading, market participants transacting faster than ever before, and some market participants, such as principal trading firms, the public might know sometimes they're called high-frequency trading firms as well. They started participating in this treasury market. And so by 2019, principal trading firms represent around 60%, so over half of the trading and volume in what's called the interdealer broker platforms in the treasury markets. Well, when I was that kid in the 1980s, the so-called interdealer broker platforms, you had the Goldmans and the Morgan Stanleys and the Solomons trading on those platforms. By God, the name of it is interdealer brokers. They stand as brokers between dealers, and over half of their volume is principal trading firms. It might be a clue as to why there's actually maybe they're dealers. In essence, these PTFs and other firms are acting in a manner consistent with dealers in the securities markets. Nevertheless, despite these firms acting as de facto market makers, and despite their regularity of participating consistent with buying and selling securities as government securities, quote, as part of a regular business, end quote, which is what Congress said in 1986, a number of these firms have not registered with the Commission as dealers. Now, I think this deprives investors and the markets themselves of important protections, the protections Congress actually was looking to fill in 1986. And again, a number of firms did register, but some have not. This deprives investors of protections that benefits market integrity, resiliency, transparency, and more. So to fill the regulatory gap, today's rule will further define what it means to be engaged in a business of buying and selling securities, again, as, quote, as part of a regular business, end quote. They will do so for both dealers and government securities dealers by requiring entities engaged in de facto market making activity to register as dealers or government securities dealers. Specifically, the rules further define these words as part of a regular business to include, and I'm quoting, engaging in a regular pattern of buying and selling securities or government securities, depending upon the circumstance, that has the effect of providing liquidity to other market participants by one of two things. Regularly expressing trading interest that is at or near the best available prices on both sides of the market for the same security, and that is communicated and represented in a way that makes it accessible to other market participants. So just thinking about that. Regularly expressing trading interest at or near the best available prices on both sides of a market and communicating it such that others can access it, or earning revenue primarily from capturing the bid-ask spread. The team will give you the further quote, but those are the two things. Now, these measures, to me, are just common sense. Now, maybe it's because I grew up on Wall Street, but and if over half the interdealer broker platforms are these PTFs, and it's called interdealer platforms, it sort of seems common sense as well. Congress did not intend for registration and regulatory requirements to apply to some dealers and not to others. Absent an exemption or exception, if anyone trades in a manner consistent with the de facto market maker, it must register as a dealer. That's consistent with what Congress's intent, but it also sort of competitively makes it fair and level. In finalizing this adoption, we benefited from public feedback on the proposed rule. We got a lot of feedback, and we benefited and made a number of adjustments. I'm going to just mention three. First, with regard to the qualitative standards, I mentioned these two qualitative standards that we're considering. We had considered a third qualitative standard. We're not including that third qualitative standard about regularly making roughly comparable purchases and sales. Second, we actually had a quantitative standard as well. We got a lot of feedback on that, and we don't have that. We did not include that quantitative standard. And third, we had some provisions with regard to aggregation across legal entities, and rather than doing that, as many commenters said, we adopted an anti-evasion provision. But I think the two qualitative standards that we have in there, to me, are fundamentally sort of de facto market making and make common sense. The final rule would promote an important cornerstone of the SEC's work to oversee the markets and this critical treasury market that's the base of our entire capital markets. Look, I want to thank so many people. The divisions of trading and markets, you'll hear from Hashang and Shauna and Randall, and they'll present this recommendation, but the Division of Economic Risk Analysis, I see Jessica and Greg are going to be with us today. The Division of Investment Management, Division of Enforcement, the Division of Examinations, the Offices of General Counsel. We have Megan and Robert's going to be presenting today. And but also our team from Strategic Hub and Innovation, FinHub we call it. And everyone's going to be listed on our website at sec.gov on this rule. But with that, Hashang, take it away.
Thank you, Chair. Good morning, Chair Gensler and Commissioners Peirce, Crenshaw, Ueda, and Lizarraga. Today, the Division of Trading Markets recommends that the Commission adopt new Exchange Act rules 3A5-4 and 3A44-2 to identify certain activities that would cause persons engaging in such activities to be dealers or government securities dealers, as defined by Section 3A5 and 3A44 of the Exchange Act, respectively. Dealers and government securities dealers are required to register with the Commission and comply with federal securities laws. In the past few decades, advancements in electronic trading across the securities market have led to the emergence of certain market intermediaries that have become significant liquidity providers. Some of them, however, are not registered with the Commission today, despite them engaging in liquidity providing activities similar to those performed by registered dealers or government securities dealers. As the Chair just previewed, this gap is particularly salient in the U.S. Treasury securities market. The Division recommends that the Commission adopt two qualitative factors that further define what it means to be buying and selling securities as part of regular business in the Exchange Act. First, regularly expressing trade interest that is at or near the best available prices on both sides of the market for the same security, and that is communicated and represented in a way that makes it accessible to other market participants. Second, earning revenue primarily from capturing bid-ask spreads by buying at the bid and selling at the offer, or from capturing any incentives offered by trading venues to liquidity supplying trade interest. In addition, we recommend deleting certain elements in the proposed rules, including A, the proposed qualitative factor that would have scoped in persons who are routinely making comparable purchases and sales of the same or substantially similar securities in a day, and B, the proposed bright line quantitative test. We also recommend replacing what is known as the aggregation component with an anti-evasion provision. The registration of significant liquidity providers as dealers or government securities dealers will level the playing field by applying consistent regulation to liquidity providers that are currently registered as dealers or government securities dealers, and to those that are not registered. The final rules will enhance regulatory oversight and support market stability and resilience in the U.S. Treasury securities market and other securities market. Let me emphasize that while today's recommendation focuses on liquidity provision, existing Commission interpretations and precedents will continue to apply. For example, underwriting activity would continue to trigger dealer registration. Before concluding, I'd like to thank the many market participants who have commented on the proposal. Your constructive feedback has significantly improved today's adoption release. I would also like to thank the Trade and Market Rulemaking team, led by Shauna Sappington of the Office of Chief Counsel, for their extremely diligent and thoughtful work. And finally, my sincere thanks go to our colleagues in the Division of Economic and Risk Analysis, the Office of the General Counsel, the Division of Investment Management, the Division of Examinations, the Division of Enforcement, FinHub, as well as the U.S. Department of the Treasury, the Federal Reserve Board, the Federal Reserve Bank of New York, and the CFTC for their thoughtful input. I will now turn this over to Shauna, who will discuss the final rules in more detail. Thank you.
Thank you, Hao-Sheng, and good morning, Chair Gensler and Commissioners. As you just heard, the Division of Trading and Markets recommends adopting new Rules 3A5-4 and 3A44-2 under the Exchange Act. These rules will further define the phrase as a part of a regular business as used in the definitions of dealer and government securities dealer, respectively. These new rules will ensure that market participants that take on significant liquidity providing roles are appropriately registered. Importantly, as noted by Hao-Sheng, the final rules are not the exclusive means of establishing that a person is a dealer or government securities dealer. These final rules will address specific liquidity providing activities of market participants. Existing Commission interpretation and precedent relating to dealer jurisprudence will continue to apply, for example, with regard to underwriting activities. The final rules will set forth 2 qualitative factors designed to capture market participants who engage in a regular pattern of buying and selling securities or government securities for their own account that has the effect of providing liquidity to other market participants. 1, by regularly expressing trading interest that is at or near the best available prices on both sides of the market for the same security, and that is communicated and represented in a way that makes it accessible to other market participants. Or 2, by earning revenue primarily from capturing bid-ask spreads, by buying at the bid and selling at the offer, or from capturing any incentives offered by trading venues to liquidity supplying trading interest. In a change from the proposed rules, the final rules eliminate the first proposed qualitative factor, which would have captured roughly comparable purchases and sales of the same or similar securities in a day. The final rules also do not include the quantitative standard that would have established a bright line test under which persons engaging in certain specified levels of activity in the U.S. Treasury market would be deemed to be buying and selling government securities as a part of a regular business, regardless of whether they met any of the qualitative factors. In addition, the definition of own account will be revised to mean an account held in either the name of or for the benefit of that person. The definition will eliminate the proposed inclusion of accounts held in the name of a person over whom that person exercises control or with whom that person is under common control. Instead of this aggregation provision, both final rules will include an anti-evasion provision intended to deter the establishment of multiple legal entities or accounts to evade appropriate regulation. The final rules will exclude persons with total assets of less than $50 million because such smaller market participants are unlikely to engage in the significant liquidity provision that the final rules are designed to address. Lastly, the final rules will also exclude registered investment companies as well as central banks, sovereign entities, and international financial institutions. In addition to Hao-Sheng's acknowledgments, I also would like to express my personal gratitude to our colleagues in TM, DERA, IM, OGC, and across the agency, including in each of your offices, who we have had the pleasure to work with on this rulemaking. Thank you for your time and consideration. Jessica Wachter will now discuss the economic effects of the final rules.
Thank you, Shauna, and good morning, Chair Gensler and Commissioners. The Exchange Act of 1934 defines a dealer as any person engaged in the business of buying and selling securities for such person's own account through a broker or otherwise, but excludes a person that buys or sells securities for such person's own account, either individually or in a fiduciary capacity, but not as part of a regular business. Today, as you've heard, the Commission is considering adopting new rules to further define the phrase as part of a regular business. Dealers perform an important market function. A securities market may have many investors willing to buy or to sell, but they may not all arrive at the same place at the same time. Dealers bridge the gap, absorbing order imbalances and providing liquidity. Specifically, dealers are important in the market for U.S. Treasury securities, where vast sums change hands on a daily basis. This market is bifurcated into an interdealer market in which dealers trade with each other, and a dealer-to-customer market where dealers trade with customers. In this market, many firms acting as dealers, bridging the gap and imbalances between dealers in the interdealer market, are not registered as such. Some of these firms may be hedge funds, but most are known as principal trading firms, PTFs, which simply means a firm trading as a principal, namely trading on its own account. Our analysis shows that 44 firms traded at least $100 billion in U.S. Treasury securities during the average month in 2022, 10 of which are not registered. Generally, firms providing liquidity in equities and option markets have incentives to register as dealers due to requirements for accessing exchanges. This is not so for Treasury markets, where the role of registered firms has declined in relative terms. As you've heard, today's rulemaking would further define the term regular business to include two prongs, one relating to regularly posting orders on both sides of the market near the best price, and a second relating to earning revenue from liquidity provision. This definition would bring liquidity providers operating as dealers into the comprehensive regulatory regime that includes risk limits, reporting obligations, and oversight by FINRA. It would address what is currently an unevenness in regulation, which may have allowed some firms to capture greater share in the market for liquidity provision because they operate with lower costs. In our view, the dealer regime confers benefits, and it is important that benefits as well as costs be evenly applied. Newly registering firms may face compliance costs. There may also be costs arising from the requirement to hold a certain amount of capital. And while there may be decreases in liquidity provision in the Treasury markets, should this occur, we do not believe it will be significant. We do believe that these rules will lessen the chance of an important liquidity provider failing. We know from past experience that such failures can be highly disruptive, and by helping to prevent such failures, the rules would promote trust in markets and therefore efficiency and capital formation. In closing, I would like to thank our colleagues from the Division of Trading and Markets, the Division of Investment Management, the Divisions of Enforcement and Examination, and the Office of the General Counsel for their collaboration. I thank all of you today for your attention.
Thank you so much, Hashang, Shauna, Jessica. I should have also thanked everybody from the Office of Secretary and Facilities and Technology to allow us to all come together. And as Shauna actually said, I believe all the people across the Treasury, the Federal Reserve, and the CFTC that helped us so much on this too. With that, Commissioner Peirce.
Thank you, Mr. Chair, and thanks, Shauna, Jessica, and Hashang for your presentation. Unfortunately, I cannot support the final rule. Even though it's streamlined substantially from the proposal, it perpetuates the proposal's fundamental flaw. The rule defines dealer in a way that is inconsistent with the statutory framework within which it sits and will distort market behavior and degrade market quality. This rule turns traders, many of whom are customers, into dealers. Doing so runs counter to the statute, as the Commission and the market participants have read it for decades. The Exchange Act defines a dealer as a person that is, quote, engaged in the business of buying and selling securities for its own account through a broker or otherwise, but importantly excludes a person that buys or sells securities for its own account, either individually or in a fiduciary capacity, but not as a part of a regular business. Nearly any firm in the financial markets that trades securities as a principal does so as part of a regular business. Recognizing the breadth of this language read out of context, the Commission has long appropriately interpreted this provision in a way that distinguishes between market participants that operate a dealing business and those that operate an investing and trading business. To this end, the Commission and Commission staff repeatedly have issued guidance on what we have called the dealer-trader distinction. The rule the Commission is considering today obliterates this distinction by extending the definition of dealer to market participants that run investing and trading businesses, not dealing businesses. Rather than looking to whether the regular business of the firm bears the hallmarks of dealing activity, today's rule would capture any person whose regular business involves trading activity for its own account that provides liquidity on a more than incidental basis. Although the Commission and its staff have previously stated that liquidity provision may be indicative of dealing activity, it has not, to my knowledge, ever before stated categorically that liquidity provision alone by a person trading for its own account constitutes dealing activity, or that trading activity becomes dealing activity merely because it has the side effect of providing liquidity. And for good reason. Once liquidity provision, not in the form of a service provided to market participants, but as an effect of one's trading activity, turns a person into a dealer, the dealer-trader distinction becomes unintelligible. The rule itself demonstrates this. The statutory trader exception is no longer sufficient to exclude registered investment companies from the dealer definition. The final rule is so broad that the Commission has determined that it needed to expressly exclude these investment funds. The express regulatory exclusion for investment companies suggests that the Commission believes that the statutory exception for traders is insufficient to exclude entities that almost no one has conceived could be dealers, that likely could not operate under broker-dealer regulations, and for which Congress has established an entirely different statutory framework. Such a narrow reading of the statutory exception is clearly a misreading of the statute. The upheaval wrought by the rule's singular focus on liquidity provision creates uncertainty about dealer status for many market participants who rely on the trader exception. Perhaps recognizing this, the Commission only briefly touches on the dealer-trader distinction in the release, conveniently avoids proffering any explanation for departing from the prior understanding of that exception, and instead asserts that the rule is intended to reflect the long-standing dealer-trader distinction. The express regulatory exclusion avoids creating absurd results for registered investment companies, but the rule still produces absurdities. The adopting release acknowledges that the market participants that will be forced to register under the final rule may not have any characteristics of dealers under the current rule. Instead, simply executing any of a number of common trading, investment, and risk management strategies could turn a market participant into a dealer if doing so happens to provide significant liquidity to the market. Not only will these entities be subject to a dealer regulatory regime that doesn't make sense for them, but they'll lose the protections now afforded to many of them as customers. In addition to harming the market participants who find themselves transformed into dealers, this rule harms the broader market. It penalizes liquidity provision, which means there will be less of it. The penalty comes in the form of a costly and ill-fitting regulatory regime for liquidity providing market participants. For playing this important role, principal trading firms, private funds, and other market participants swept up by the rule will now have to register with the Commission and become members of an SRO and comply with Commission and SRO rules, including certain financial responsibility and risk management rules, transaction and other reporting requirements, operational integrity rules, and books and records requirements. They also have to become members of SIPC. When serving the markets comes with such onerous and unsuitable regulatory requirements, some market participants will decide to stop serving the markets. The Commission is attempting to solve the problem of inadequate liquidity provision in times of crisis by reducing liquidity provision ex ante. How this advances the Commission's objective of shoring up liquidity provision is beyond me. The Commission, though, cast this rule as part of an effort to protect competition. The rule, though, will drive competition out of the markets by penalizing trading and investment strategies that have the effect of providing liquidity to the markets. The rule will dampen liquidity provision. The extra costs will cause firms to consolidate so that they can spread the fixed costs of the dealer regulatory regime over more activity. Small and mid-sized participants that enhance the diversity and robustness of the ranks of liquidity providers will disappear, and liquidity providers will become more concentrated and more homogeneous, which will make both these firms in the market more fragile. The Commission contends that this rule is necessary to give us more comprehensive regulatory oversight of securities markets. The SEC commonly falls back on this justification for rulemaking, but being an effective regulator does not require comprehensive surveillance and a prescriptive regulatory regime governing the activities of every market participant. In any case, we already have lots of data to conduct regulatory oversight. Consolidated audit trails, comprehensive monitoring of the equity and options markets, the ever-expanding Form PF to collect granular private fund data, the trade reporting and compliance engine, large trader reporting data arising from mandatory proprietary trader registration with FINRA, and the list goes on. A regulator's temptation may be to put every corner of the market under a regulatory spotlight and into a regulatory straitjacket. But a clear-eyed view takes into account the costs of such comprehensive oversight to the healthy, dynamic functioning of the market and the investors and issuers that participate in it. In addition to these fundamental flaws, the new rule comes with other problems, including serious implementation challenges. The rule is ambiguous in scope, which almost certainly will bring in firms the Commission had no thought of including. These firms will incur significant costs in registering as dealers or changing their businesses, so they don't have to register. The implementation period is too short, particularly given that we have to coordinate with both FINRA and SIPC. The likely interactions with other rules are unpredictable, some rules which are still being proposed. And not surprisingly, the rule reflects little thought regarding its practical application in the crypto markets. I do want to thank the staff in the Division of Trading and Markets, the Division of Economic and Risk Analysis, the Office of General Counsel, for your work on this release. You continue to impress me with your diligence and concern for the well-being of our markets. I know that the work will not stop with today's rulemaking adoption, but there'll be continued work through the implementation period, so thank you in advance for that. I do have a number of questions, and my first is for Jessica. The economic analysis acknowledges that the rule's consequences are hard to predict. So what metrics do we plan to use to measure the positive and negative consequences of this rule when we do a retrospective review in a few years?
We're always interested in the consequences of our rules, and this is something that DERA and Trading Markets have a keen interest in and will keep in mind. So the release talks about several academic studies that develop metrics to quantify the functioning of securities markets. And so one thing one could do is replicate those studies on newer data. I think another thing you could do is to look at the potential effects on competition. So the release talks about the current state of competition for liquidity provision, and one could look at that going forward.
Okay, that's helpful. With respect to liquidity provision specifically, what will we be able to measure to determine whether liquidity provision has been harmed? What kinds of things would you look at?
So one of the studies that we talk about in the release looks at the relation between volatility and liquidity. And there does appear to be a stable linear relation, which is something that theory would predict. But there are times where you see liquidity go beyond what you would, illiquidity go beyond what you would predict. And so that would be something to look for in terms of liquidity provision.
So does that mean that you'll be looking at liquidity provision at specific moments of stress in the markets, that's where you'll specifically suggest that we focus in a retrospective review?
So that measure can be used at any time. It doesn't have to necessarily be periods of stress.
And then if you had to give one thing that you would look at to say 5 years from now, this rule has been a tremendous success, is there any one thing that you could look at that would indicate that it was successful?
Well, so beyond what I just talked about, I think the rule does have the aim of bringing firms that are meeting the definition into registration. And so I think that would probably be the most direct metric of success.
It's just the increased number of registrants.
To the extent that they're meeting the prongs, yes.
So one of the things that's really puzzled me about this rule is we're not scoping out private funds or pension funds, even though that having a private fund or a pension fund register as a dealer is just a really strange, it's very hard for me to get my arms around what that would actually look like. So what's the logic for excluding registered investment companies, but not private funds and pension funds, which are also pooled investment vehicles?
The funds are not subject to the extensive framework of the Investment Company Act. And depending on the totality of the facts and circumstances, a fund may be engaged in the business of buying and selling securities for its own account. That said, with the modifications that we've talked about to the final rules, we believe that pension funds and many private funds will generally not be captured under the final rules.
So then why was it necessary, if pension funds aren't pulled in, why was it necessary to exempt, for example, government entities? Because presumably if the same thing that would keep pension funds out would keep those government entities out. What was the thinking there?
So I'm happy to answer this one, Commissioner. I guess you're talking about maybe the Federal Reserve or maybe different national governments. When they trade the U.S. Treasury securities, it is part of their official job to implement a monetary policy or maybe maintaining a foreign reserve. So there is a very distinct function they are providing to the market. So that's why we thought it's appropriate to exempt them.
So sovereign funds could have to register as dealers.
That is not a part of the explicit exemption because certain foreign sovereign wealth funds do trade actively. As Shauna just mentioned, that depends on the facts and circumstances.
So have you thought about, and I'm sure you have thought about this, but how many private funds you're telling me probably no pension funds, maybe sovereign wealth funds. So how many sovereign wealth funds and private funds do you imagine might be, or do you anticipate might be pulled in? Assuming they don't change their business, their activities from what they're doing now.
Well, I would defer the number to our chief economist.
So our estimates are that fewer than 16 private funds will fit the definition.
Any thought on number of sovereign wealth funds that could be pulled in?
So our estimation comes from two sources. One is the Treasury Reporting and Compliance Engine, TRACE, that you mentioned before, and the other is Form PF data. So that's the source of the data. So we don't have the data on all the different potential parties here. In TRACE data, there are four private funds that are identified by our analysis, and there's a very small number of other entities, and it is conceivable that they might be sovereign wealth funds. Though I think I would characterize it as highly unlikely, but not impossible.
And do you think for private funds, or if there were a pension fund, for example, that had to register as a dealer, do you anticipate there'd be any unique challenges for these entities that they would face in registering or operating as dealers while also operating as private funds?
Commissioner Peirce, I think this comment also resonated in the comment file as well. So I'll turn to the team in a moment, but before doing that, I just want to briefly observe that the legal status of a firm is not carved in stone. And in practice, we do observe that certain private fund complexes, they would have affiliated broker-dealers separately registered, so that there's a way for people to carve out or separate dealing activity from investment activity and have both of them registered under different umbrella. Having said that, the comment file does talk about net capital rule, as you mentioned earlier. So we do have Randall Roy from the Office of Broker-Dealer Finances who can speak about net capital.
Yeah, obviously, if they register as a broker-dealer, they will be subject to the net capital rule. The way the rule is structured, it imposes differing requirements based on the activities that the firm does. So, for instance, the most rigorous requirements apply to a we'll call it a full service broker dealer that does custody, prime brokerage, market making, et cetera, uses models. That type of firm would have a $5 billion minimum fixed dollar net capital requirement. A firm that engages solely in dealing activity and doesn't use models would have a $100,000 fixed dollar minimum net capital requirement. And that's just two examples, but the rule is sort of tiered in that way. It looks at the type of activity the broker dealer does, and then it sets the capital requirements for that firm accordingly.
Thanks. Are any hedge funds or other private funds now subject to the net capital rule?
If they're a broker dealer, they are.
And so there are hedge funds that are also broker dealers?
There are broker dealers that deal exclusively with other broker dealers.
And that are registered. So they're registered as dealers.
That's correct.
Okay. And so, Haosheng, you mentioned setting up a different entity to register as a broker dealer and splitting off the conduct that would make the hedge fund a dealer. But that seems to sort of conflict with what you're getting at with this rule, which is you're saying, look, these are entities that in the course of their normal activities have this side effect of providing liquidity to the markets. And so we want to swoop in and make sure that they're registering. But if you're saying, well, all you have to do is cut out all that activity, I mean, doesn't that cut out the heart of the fund that has led it to be the entity we want to make register?
Just to clarify, Commissioner Peirce, I think the merit of the question is, I guess what you're saying is, what if a fund today is doing dealing activity? I think at that point, we should ask the question, if you look at the nature of the business, is that an investor, right? Investing for the long-term price appreciation or price convergence, or is that dealing, capturing bid-ask spread, posting quotes? And the fund would have to make its own determination. What I was suggesting simply reflects the fact that certain fund complexes today do have affiliated broker-dealers. I by no means suggesting that it would defeat the purpose. In fact, if they are indeed dealing, some of the broker-dealers are registered today, even though they are affiliated with the funds. So people have found a way to comply to both regimes.
Yeah, by setting up a separate entity, though, it sounds like, is the standard way.
No, well, we discussed that in the release, right? They could change their legal structure, or they could separate dealing from investing.
And that wouldn't violate the anti-evasion provision.
I mean, anti-evasion is really about capturing activities that would avoid, basically evade registering as dealing. But in this particular case, Commissioner, I think you are talking about a fund maybe carving out part of activity and register. So I don't know why that would be evading the dealer regime.
Okay, good. And so how does the relationship of a private fund with its broker dealer change if it becomes a dealer under this new rule?
Again, I would invite Randall to.
Again, the broker dealer would be subject to the capital requirements. I would presume that's where the dealing activity would be done. The hedge fund would, and I'm not an expert on hedge funds, so I really don't want to get into that too much. But the hedge fund, I assume, would.
You will be soon.
Fair point. What the hedge fund would do would, I assume, the non-dealing type activities that hedge funds engage in.
Yeah, I mean, I think one of the concerns that people had was that they're, flipping from customer to dealer, you lose some of the protections and the opportunities that you would have as a customer, but not as a dealer. Let me just turn to crypto markets for a second. The release doesn't spend a lot of time talking about crypto, but does explain that an automated market maker might have to register as a dealer under the final rules. I'm trying to understand what that looks like, because an AMM, as I understand it, is just a software protocol. So how does it register as a dealer?
Commissioner Peirce, I'm happy to take this one. Automated market maker is more than a software. Software is part of it. That's the means by which people can deal. On the other hand, there is a pool of asset, in this case tokens. Typically, it's organized as a pair, token A and token B. And people would deposit a certain amount of token A and token B, so that when investors come in and try to exchange one for the other, there would be a price defined by a mathematical formula, sometimes called a bonding curve, that would define the exchange rate. So in that sense, whoever depositing the tokens could be one person, could be multiple persons, they would essentially be acting as dealer because they would have bid offer prices determined by the bonding curve, and they will be making profit and the revenue based on the bid-ask spread. So in that sense, there's really nothing special in this case about crypto. It's very analogous to a regular broker-dealer making the markets posting bid and offer using the usual software. So again, we are not trying to capture technology, but rather people who use the technology for dealing.
So it's not the AMM that has to register. It's the people posting liquidity in those pools that have to register.
Commissioner, I think we have to be very careful about the word AMM. I think in the popular press, it might be, people have different interpretation of this label AMM. Again, as I mentioned, there's a technology front, which is the software that people can use. But then there's a pool of asset that the people contributed. And essentially, I think we should really distinguish these two parts. There's the people behind what is going on, and there's the means by which people are doing dealing. So I wouldn't say it's AMM in or out. We have to be very careful about the words here.
Technology out, people in is what you're saying.
Well, there's technology, but then there's people using technology to deal.
The person who writes the code doesn't have to register. It's the person who uses who posts assets into the pool.
Again, I think that depends on the facts and circumstances. If you use a software and the person writing the software only does the software itself, but that doesn't have anything to do with the dealing activity, then that would be unlikely something that we try to capture. On the other hand, if you write the software and also you are the person who is trying to use the software to deal, in this case, crypto securities, then maybe you are in. So again, I think this does depend on the specific facts.
So how many people do we think are, let's just focus on the people. How many people do we think are going to be pulled in if they continue doing the same kinds of activities they're doing today by this new rule?
Sorry, people, do you mean in crypto security market or
I mean,
generally?
just focusing here on the people who are posting liquidity in these automated market maker pools.
I mean, I'll defer to Jessica, but this is the market that's not that transparent or compliant, so we don't really have great data, unfortunately.
I mean, I think one of the reasons they're not compliant is because they can't figure out what our rules are, and they can't even figure out when we think that something is a security. So that seems to me that it's going to be a tremendous implementation challenge for us, unless we're planning to provide some clarity. What is the commission planning to do work with FINRA and SIPC? And I'm not referring here only to crypto issues, but to ensure that all of the new registrants pulled in by the rule will be able to be onboarded within the 1-year compliance period.
All registered broker-dealers by law are automatically SIPC members, except for certain types of broker-dealers that are excluded from membership. And there is no onboarding process, as far as my understanding. FINRA has provided an express commitment to expedite the application process for affected parties covered by the final rules. But as a general matter, the staff will be happy to receive inquiries and questions from FINRA, SIPC, the industry, relating to compliance with the final rules.
Okay, that's helpful. So a couple follow-ups on that. With respect to SIPC, are there any unique issues that SIPC is going to have to think through, given that we're pulling in entities that are different from traditional broker-dealers?
I don't think so, because again, there are broker-dealers today that transact only with other broker-dealers. So it's not I don't see it as a very unique new set of registrants.
Can I just ask you, though, if a hedge fund, for example, had to register and it failed, wouldn't that be a first for SIPC of trying to figure out what its role was?
again, if it's a broker-dealer, it would be liquidated under the Securities Investor Protection Act. A trustee would be appointed. Customer assets would be marshaled and returned. But it may well be that SIPC wouldn't even have to get involved because, of course, to start a SIPC liquidation, you have to have a customer. So these firms may not have customers at all, in which case SIPC would not even.
So why do they have to be SIPC members if they don't have customers?
Because SIPC, the statute was designed in a way that all broker-dealers become members of SIPC so that all broker-dealers pay into the SIPC fund, which protects the industry as a whole.
Okay, and then with respect to FINRA, Shauna, you mentioned that they've pledged that they'll be ready to go. But we can't even tell them how many potential entities may be coming in to register. And we know that specifically they've had problems with crypto registrants. It's not been an area where things have gone smoothly. And then there's a lot of other activity going on at FINRA. So how do we have confidence that if there's a problem, we don't end up with a whole swath of people who are in violation of the rule simply because they couldn't register in time with FINRA?
I think this is a good question, Commissioner. FINRA made this commitment in response to the proposed rule. So they saw the proposed economic analysis. So they have some idea about how many, at least from the proposed rules, how many affected parties there would be. I have no reason to doubt FINRA's judgment. It will just have to be a situation where we work with FINRA during the implementation process, and we just continue to monitor.
Okay, well, as I said, I think you'll still have a lot of work to do. You can't rest after today. Just final question around investment advisors. So investment advisors are not excluded from the rule explicitly. We've made some changes that make it less likely, I think, that they'll be pulled in. But why would it make sense to pull in investment advisors who are registered and subject to a regulatory framework? Why would it make sense to have them also have to register as dealers? And would that potentially lead to any conflicts between their dealer obligations and their fiduciary obligations?
As you mentioned, but really importantly, we do think that the modifications we made to the final rules will largely, they generally will not be captured under the final rules, especially around the modifications we made to the definition of own account and removing that aggregation provision. With the new definition of own account, an investment advisor that is advising on behalf of its clients, it's transacting on behalf of its clients, would not meet the definition of own account. That said, if an investment advisor is engaging in dealing activity, then we do think that they should comply with their regulatory obligations.
So the example that I could think of is if you have an advisor who seeds a fund, provides seed capital for a fund, and is running that fund, that might be an instance where it could have to register. Is that correct? And if so, does that pose any conflicts? Because the fiduciary duty is owed to the fund, but the dealer's duties are owed to other market participants, I guess, right? So is there any potential conflict there? And is that scenario one where an advisor might have to register?
I think the determination is highly fact specific. And again, I'm not sure that under those circumstances, an advisor would have to register. It's really going to depend on the facts and circumstances. But if an advisor engages in the activity that's contemplated under the final rules, then we would expect them to comply with their regulatory obligations under the rules. And we think this is important because the dealer regulatory regime is tailored to the specific role that dealers play in the securities markets. And because of the important benefits that have been discussed that relate to the dealer regulatory regime, to address the activities specifically relating to that dealer activity.
So could there potentially be a conflict, though, between those two sets of obligations, the dealer obligations and the fiduciary obligations?
So, Commissioner, if I could quickly chime in, I think again, as we think about the thin sliver of firms that are potentially captured, rather than asking, all right, they are funds or they are advisors, kind of taking the legal status as given, I think we should also ask the question, what is the nature of the business? I think that's a more fundamental question. If a advisor or the fund is actually doing dealing, so I think we should sort of just ask the question, well, why they are not registered as dealer? I think once they pick the choice, right? Make the choice either as an investor, fund, or advisor, or as a dealer, then we can think about the proper regime. Back to your question, I think practically speaking, it's very unlikely that there will be any conflict arising.
Well, I appreciate all the answers, the thought that you've put into this. I still do have concerns that we're forcing a regulatory regime on a set of entities that it's going to inevitably cause some very difficult questions, both for us, but more importantly, I think for the firms that have to face these conflicting obligations. I don't have any additional questions.
Commissioner Crenshaw, if you'll bear with, just two things. I would note, Commissioner Peirce, on your questions, there is a de minimis, I think Shauna said 50 million, I'm trying to remember. So some participants in, whether they're in the crypto or in the non-crypto space, there's this de minimis that's in.
So I hear you on that, and I think that's going to be helpful for a lot of entities. But I think part of what is really troubling me about the rule is that because we've sort of opened the door to say, no longer is it what you intended your behavior to be about, it's what the consequences, the effects are, the positive effects in this instance of liquidity provision. It pulls you in. So it's, and we have specifically said, even if you're not covered by this rule, don't think that you're free and don't have to register as a dealer. So we kind of give with one hand and take away with the other.
See, I see it differently. As you can tell, it's likely that you're not supporting this rule, and I am supporting this rule, but I see it differently. It's a consequential choice you make as a business. Do you, as a regular business, as the statute, as Congress has written the statute, as a regular business, you're engaging in dealing, and that providing the liquidity, that's a choice you make. I also don't think it conflicts with the fiduciary duty. I know, and I say this as a former partner of a major broker-dealer. So I had a fiduciary duty to my fellow partners. There was 128 of us. We had a fiduciary duty to each other to maximize revenue and profits. But we also knew we had to comply with the securities laws, and that we, even when I was there, knew of Mike Macaroli, and we had to make sure that, we complied with that for the public. This is a really esteemed member of the SEC, who's still an esteemed member of the SEC. So we live in a world of law written by Congress and the rules of the securities and is interpreted by the courts, but we were definitely fiduciaries living within those rules and laws, maximizing revenue and profit.
Yeah, I think the question, though, that I was asking, and again, Shauna assures me this is a pretty unlikely scenario that you'd have a registered investment advisor have to register also as a dealer. And in that case, the registered it's not the situation you described where you have fiduciary obligations to your own entity. You have fiduciary obligations to a client, your advisory client, and also potentially you have obligations to customers in your dealer capacity. And that's very complicated to me. I don't understand how that plays out.
Yeah, I think it's a little bit more straightforward because I didn't think the advisor, just the advisor, which is a management company, is, as Shauna said, is quite unlikely as a regular business providing that liquidity. But maybe somebody they're advising, the fund or somebody else, might have to register. It's still, I understand the numbers are, very modest numbers that Jessica just went through. So we're in a different place, but.
Well, we'll see if Commissioner Crenshaw convinces me.
Yeah, well, but Commissioner Crenshaw, take your best shot.
Well, that's a lot of pressure. My hopes are slim on that one. But the Securities Exchange Act of 1934, the Exchange Act, provides the SEC with broad authority over the securities industry, including the power to register, regulate, and oversee participants in the securities markets. The dealer regulatory regime is a key component of the U.S. federal securities laws, and dealers perform important market functions, such as absorbing order imbalances. In other words, when a market receives more buy orders than sell orders at one point in time, or vice versa, as you heard Director Wachter talk about, and providing liquidity to buyers and sellers in the market, as you've also heard. Under the Exchange Act, the SEC has the authority to define the terms used in the statutory definition of dealer and oversee and regulate registered dealers. The Exchange Act defines a dealer as any person engaged in the business of buying or selling securities for their own account. Dealers help facilitate investor trading because dealers are willing to trade for their own account as principals when investors cannot immediately find other investors with whom to trade. In this way, dealers provide the service of immediate trading. The Commission has long identified the provision of liquidity, including acting as a market maker or a de facto market maker, as a factor that indicates dealer status. In recent years, advancements in electronic trading have resulted in certain market participants playing an increasingly significant role in providing liquidity. Of course, liquidity can be positive, but when the providers of significant liquidity are not compelled to comply with the registration requirement, it does raise concerns. For example, if a liquidity provider that is a substantial market participant fails, then its disorderly exit from a securities position, or even the market more generally, could push market prices away from fundamental value and potentially harm traders across markets. Because a significant liquidity provider can harm others to whom it is not directly related, its failure has potential to impose significant costs on other parties. There's a clear loophole here. Market participants with a significant share of market volume are engaging in activities like those performed by dealers without being registered as dealers. This has left both investors and the markets without important protections, such as limitations on financial risk, reporting and disclosure requirements, and other benefits that would result from registration and regulation under the Exchange Act, regulation designed for this specific dealer activity. The rules we're considering today would help close this regulatory loophole and level the playing field by subjecting market participants that perform similar dealer functions to a common regulatory regime. The regulatory regime for registered dealers includes, among other things, books and records requirements, reporting and disclosure requirements, including audited financial statements and the identities of owners, directors, and managers, the net capital rule we talked about, original integrity rules, and these requirements help enhance market stability by giving regulators increased insight into firm level and aggregate trading activity, which helps regulators to evaluate, assess, and address market risks. In addition, registered dealers are also subject to the Commission's authority to conduct examinations and impose sanctions, and are also subject to the rules, examination authority, and enforcement authority of relevant self-regulatory organizations. Moreover, registered dealers and government securities dealers are required to comply with all applicable securities laws, which include anti-fraud and anti-manipulation provisions. Although the regulatory regime differs somewhat from market participants that transact only in government securities, as you've heard, firms that are government securities dealers, including registered broker-dealers trading government securities, must also comply with rules adopted by the U.S. Treasury, including rules relating to financial responsibility, record-keeping, financial condition reporting, and risk oversight. On the whole, the regulatory requirements that apply to dealers, including today's rules, provide fundamental protections that contribute to fair, orderly, and efficient markets. The rules will also apply consistent regulation to market participants that regularly provide significant liquidity. Today's rules thus begin to level the competitive playing field between liquidity provision conducted by entities that are currently registered as dealers and those that are not. Registration should enable more comprehensive regulatory oversight of those participants. I'd like to thank the staff of the Division of Trading and Markets, Division of Economic and Risk Analysis, the Office of the General Counsel, FinHub, who else am I forgetting? Exams, I think, all of the various divisions, as well as facilities, IT, and the Secretary's Office for helping facilitate today's meeting. We appreciate all of your hard work, and I am pleased to support today's rule. Thank you.
Thank you, Commissioner Crenshaw. Commissioner Ueda.
Well, thank you, Chair Gensler, and thank you, Ashang, Shauna, and Jessica for your presentations. Fortunately, I find today's action problematic. The Commission's effort to classify nearly any person who buys and sells securities as a dealer, government securities dealer under the Securities Exchange Act, extends far beyond our statutory authority. The lack of any limiting principle creates the potential for arbitrary and capricious government action. Further, today's action may reduce liquidity in the Treasury markets, make them more volatile, reduce the number of liquidity providers, and increase debt costs to taxpayers. The Exchange Act limits who is a dealer by requiring that the trading from one's own account be as part of a regular business. The final rules fail at their attempt to clarify what part of a regular business means. Instead, they proclaim that no presumption shall arise that a person is not a dealer within the meaning of the Exchange Act solely because that person does not satisfy the standards set forth in the rules. In other words, complying with the rules provides no assurance on dealer status, whether in the Treasury markets or beyond. Today's action codifies the Commission's view that the dealer definition is practically limitless for all intents and purposes. The public should be concerned about the immense scope of this claimed jurisdiction. The rule of law means that government should define ex ante which activities are lawful and which are not. Without such definition, government authority can be arbitrary and even tyrannical. Through enforcement discretion, government can favor some entities while disfavoring others. This rulemaking targets proprietary trading funds, private funds, and others who make money by buying low and selling high in the Treasury markets, while creating additional regulatory confusion in other markets, including crypto asset securities. Indeed, following Form PF, the adoption of the private fund advisor rules, security lending disclosure, and short position and short activity reporting, this action feels just like another salvo in the Commission's ongoing war on private funds. The Commission claims that advancements in electronic trading across securities markets resulted in PTFs and others providing more liquidity to the Treasury markets, a traditional dealer activity. While that may be true, it does not legally transform traders into dealers. Broadly speaking, any market participant can be a liquidity provider, and it makes no sense to use liquidity provision as the basis for legally distinguishing between traders and dealers. The role of principal trading firms and private funds has grown in the Treasury markets, partially because the amount of outstanding public debt has massively increased in the last 4 years. In January 2024, total outstanding public debt was about $34 trillion, with $27 trillion held by the public. 4 years, those amounts were $23.2 trillion and $17.1 trillion, respectively. Yet primary dealer balance sheets have stayed relatively flat and are constrained by the supplemental leverage ratio. If the banks and dealers cannot provide additional liquidity, where will it come from? Nearly omitted from the Commission's analysis is that principal trading firms and private funds provide positive externalities to the Treasury markets through increased liquidity, more competition, and tighter spreads. The Commission suggests the benefits of imposing dealer regulations on PTFs and others include that 1, these entities will be less likely to discontinue trading in turbulent markets. 2, regulators would have more information about their activities. And 3, the playing field would be leveled. Overlooked is the fact that dealer regulations are designed to protect customers, not to address whether PTFs and others might stop trading during market turmoil. For example, The net capital rule protects customers during a wind down, but is costly and inappropriate for firms that lack customers. Unsurprisingly, the Commission cannot convincingly demonstrate any gains in investor protection as a result. Ironically, today's action promotes the very outcome that it seeks to avoid. Increasing costs on non-dealer liquidity provision will generally result in less liquidity and/or higher transaction costs. As justification, the Commission provides two examples: the March 2020 COVID lockdown and the 1982 failure of Drysdale Government Securities, which the chair referred to earlier. I find on that specific incident, I find it somewhat telling that it's from over 40 years ago. I was only a sixth grader at the time. I wasn't actually in the business yet.
No, but it was the thing that led Congress to act. So it does relate to the why did Congress act? And Chase Bank lost $270 million. So,
well, Congress did indeed act, and then they did pass the Government Securities Dealers Act in 1986. Now, as for March of 2020, the unprecedented global shutdown reduced liquidity for all asset classes. The PTF's decline in liquidity provisions in March 2020 appears somewhat anomalous. By contrast, if you look to the March 2023 Treasury market stress, PTFs increased their activities in the Treasury markets and provided a greater share of liquidity. Treasury Undersecretary for Domestic Finance Nellie Lang noted that this higher share is more consistent with past behavior, such as during the October 15, 2014 event. Yet the adopting release fails to credit PTFs with providing increased liquidity during times of Treasury market stress, including 2014 and 2023. There are already tools that constrain and monitor risks by PTFs. When PTFs trade through a bank or broker-dealer, Federal Reserve regulations T, U, and X limit the principal trader's risk by imposing margin requirements. If they trade through a broker-dealer, Federal Rule 4210 may apply specific margin requirements. If they trade them directly themselves, the SEC's market access rule requires a sponsoring broker-dealer to establish, document, and maintain a system of controls and supervision designed to limit the risks of the principal trader's activities. The argument about leveling the playing field entails a fundamental economic fallacy. When a business engages in an economic activity, it weighs the incremental or marginal benefits against the incremental or marginal costs. Even if current registered dealers have fixed regulatory costs associated with other activities, such as trading equities or dealing in equities, they can remain competitive in the Treasury markets with PTFs and private funds because their marginal regulatory costs are not tightly linked to that activity per se. However, increasing the regulatory costs for PTFs and private funds will lead them to supply less liquidity to the Treasury markets, and some firms may exit. Suggesting that there is an intrinsic public benefit tied to increasing the cost on lesser regulated liquidity providers is misguided. The argument that the Commission needs more information on PTF transactions is similarly weak. The SEC already has access to substantial data. Most PTF trades occur on interdealer broker platforms. Broker-dealers and ATSs report transactions in U.S. government securities to TRACE, and TRACE data includes the identities of unregistered entities. For non-Treasury transactions, the consolidated audit trail generally includes all principal trader orders in NMS securities, over-the-counter equities, and listed options because they are reported by other registered parties. Finally, principal traders with high volumes or with large portfolios may also have to report to the Commission on Form 13F or Form 13H. The final rules exclude investment companies registered under the Investment Company Act, but not private funds or collective investment trusts. The Commission largely relies on the same rationale described in the proposing release for not excluding private funds, including the comprehensive regulatory framework and extensive oversight of registered investment companies under the Investment Company Act of 1940. Yet the Commission has not considered the aggregate effects of the various rules proposed and or adopted for private funds since the proposing release for this particular rule came out. The lack of such analysis makes the final rules arbitrary and capricious. Today's actions also follow other Commission rule changes that have continued to increase the number of persons we are requiring to register with FINRA by sweeping ever more and ever larger numbers of persons into FINRA's regulatory orbit. It makes FINRA start to appear like a de facto federal securities regulator. As such, perhaps it is appropriate that consideration begin as to whether or not FINRA is a state actor. If they're going to regulate almost everyone, then I think it's an open question. Under the Commission's approach, any person can be a dealer if they buy and sell securities as part of a regular business. Now, the final rules modify some of the provisions from, quote, routine to, quote, regular. But that provides no further clarity, market participants. This ambiguity is highlighted by recent litigation over the dealer definition, when the Commission argued that the, quote, Exchange Act does not define what it means to be engaged in the business of buying and selling securities. But this entity is a business. It has offices, employees, keeps accounting records, and carries on for a profit. And its business model is to buy and sell securities, unquote. That was from a complaint that the Commission filed in an enforcement action. Now, historically, dealers had customers. The Exchange Act's definition of broker and dealer generally reference how customer securities transactions are effectuated. Brokers act as agents. They trade for the account of their customer. Dealers take the opposite side of a customer's trade for their own account. The Commission, in today's final adoption, really selectively cherry picks one treatise from the 1930s to support its view that a dealer can have no customers, while ignoring a contemporaneous treatise stating that, quote, a dealer sells to and buys from a client, whereas a broker buys and sells for the account of a client, unquote. Until recently, the Commission has enforced dealer registration in a manner consistent with the idea that brokers and dealers relate to customer orders. That view has apparently changed through regulation by enforcement. As a result, persons are subject to Commission enforcement, even though they've been operating under the same business model for a long time, with the understanding that they were not dealers. The Commission has filed a number of cases on dealer registration, including a recent settlement with REA Goldstein. Mr. Goldstein loaned money to publicly traded companies through convertible debt agreements. Mr. Goldstein could convert unpaid debt and interest into discounted stock after waiting 6 to 12 months as required under Rule 44. Staff guidance available on the Commission's website since 2008 suggested that individuals who buy and sell securities for themselves are not considered dealers and lists a number of factors for consideration. Mr. Goldstein and his firm did not appear to hold themselves out as dealers. They didn't have customers. They didn't advertise themselves as such. The Commission's rulemaking could have addressed this regulatory ambiguity, but it did not. Given the negative consequences of the final rules, combined with the continued ambiguity on who is a dealer, I'm unable to support. Many of the anticipated costs are fixed, and small firms, in particular, will be disadvantaged. A number of the Commission's findings supporting the final rules are speculative and lack sufficient data or evidence in the administrative record. While the Commission recognizes that a decrease in the activities of liquidity providing entities and their investors would harm market liquidity, and that the harms to the Treasury markets may be pronounced than to other markets, it theorizes that if that were to occur and bid-ask spreads were to widen, other registered dealers might increase their own trading to offset the gap. Wishful thinking is not a strategy when it comes to the Treasury markets, the most important in the world. But I do want to thank the staff in the Division of Trade and Markets, the Division of Economic Risk Analysis, the Office of General Counsel, as well as the comments we received from our many counterparts throughout the federal government who have provided their thoughts on this. So a couple of questions. First off, one of the provisions that we have in the definition is at or near. What exactly do we mean by near when it comes to determining whether or not you fall within the definition or outside the definition?
Commissioner Ueda, thank you for that question. I'm happy to start, and I would invite Jessica to chime in as well. I think the reason that we kept it at generic is because different securities with various liquidity profiles would have a different, if you like, the price impact. So I think the word at or near would depend on the kind of securities we are talking about. If you're talking about treasury securities or index equities that are extremely liquid, maybe near would have different meaning from something else that is less liquid. So that's why the words there would really depend on the facts.
Well, you could have done a formulaic approach, for instance. Would you consider something that is more than, say, 3 standard deviations away from past volatility for a 3-month period to be near or far? What would one do if I'm a market participant? I'm trying to figure out whether or not I fall and have to register as a dealer.
As maybe Commissioner is attractive, it sounds to have a formulaic approach. I think the word standard deviation could also, depends on whether you're looking at this time period or different time period. I mean, it's not as simple. So that's why we thought it's better to keep the words to be generic, and we would judge based on the facts rather than giving a particular formula. That I thought you don't, generally have the concern about a very prescriptive approach.
All right, so who makes that judgment then based on the facts? I mean, you're saying that you completely are at the discretion of enforcement, since if someone concludes that they're not a dealer, they're not going to be in the exam, they're not going to register, so they'll be covered by exam. So it's going to be somebody in enforcement who might decide, well, I just want to send a message. Is that what your expectation is, that enforcement makes the decision?
So again, Commissioner Ueda, we cannot really speculate on the hypothetical at this point. Unfortunately, I can't really answer that question on the specifics.
Well, we kind of have to speculate, because isn't that our obligations in the Administrative Procedure Act? We actually have to have an idea of what might be a reasonable outcome of behavior on affected persons. We just can't, if we don't have any idea, then that strikes me as we don't have a rational basis and we've engaged in arbitrary and capricious rulemaking.
Commissioner Ueda, if I might, ultimately, it's this commission and our successors. I mean, enforcement, just for the public, doesn't just file things in court. Everything's voted on by this commission. So on that one thing, I just want to make sure the public understands. It might have been a rhetorical thing you were doing there, but it's a commission that brings enforcement actions based on the facts and the law at that time.
I've been engaged in reviewing enforcement recommendations since 2006 at this commission, off and on. And this commission has no say, particularly after we changed the rules to delegate authority for formal orders to the Director of Enforcement, until something is brought before us. And there are many reasons, including the ones that I thought Commissioner Peirce was very eloquent in her statement last week, as to why someone may decide to settle with us. And settlement's the first time that the commission gets to consider it. So I think there is quite a bit of power and authority in the hands of our enforcement staff as to whether or not to launch an investigation. And by the time anyone here on the commission, and first off, I want to recognize that our enforcement staff works very hard to try and get the right answer. But that's the first time that we see it. So yes, I do fully appreciate that ultimately it's on us and our successors and our predecessors, everyone who's ever voted on that as to what to do. But I don't think it reflects reality to suggest that enforcement has no influence on those decisions.
It's a very important function of this agency, and I'm so proud to be associated with the 1,300 people in enforcement. I just wanted to make sure the public understands that any enforcement action ultimately rests on, decisions by people that fill these seats.
Yeah. Well, again, this gets back to whether or not an investigation is even initiated. And so in terms of, if you're a market participant trying to figure out what am I supposed to do, the person making the decision as to whether or not I did the right thing will be enforcement. And, the failure to register is a non-scienter charge. It doesn't really matter if you made a really good faith attempt to figure it out and you concluded I was not a dealer if someone second guesses you. And I think that's, an important point. None of the persons who would be affected by this, they're all, everybody who would be currently affected by this, who might be brought into the dealer reporting regime, aren't they currently subject to the anti-fraud, anti-manipulation rules, even though they're not registered as a dealer? I mean, isn't somebody who is a trader subject to 10b-5?
Yes, they are.
All right, thank you. And they're also subject to the anti-manipulation rules too, like wash sales and like, aren't they?
Yes, that's correct.
All right, thank you. All right, with respect to, one of the things that we added in the final rule was some exclusions, including for sovereign entities, which we define as a central government, including the U.S. government, or an agency, department, or ministry of a central government. So that was not in the proposal, isn't that right?
That's correct.
Okay, so what exactly does it mean? Would the state of Texas be a sovereign entity under the rule?
The definition of sovereign entity is a central government, including a U.S. government, or an agency, department, or ministry of a central government. So if the state of Texas falls into that definition, then I'm going to answer yes.
All right.
But I am no expert on sovereign entity.
I mean, look, the reason why I bring this up is not so much whether we need to read an answer right here now, but it is, there are important things in the details here. And so if I go back to my first year con law, you understand that the Constitution, creating the federal government, created a government of limited authority that was ceded to by the states, and the states retained all aspects of their sovereignty. These are the types of questions, and I think Commissioner Peirce said there's going to be a lot of work to do on this because it makes a big deal. If the state of Texas is a sovereign entity, then, well, what does it mean to be an agency, department, or ministry of that in terms of all the counties, all the school districts, all the water districts, everyone else who's the state universities who run endowments? Are they, or do they not fall into this? Because that's, as a gating issue, if they're carved out from the very beginning, they don't even need to worry about going through all of these tests as to whether or not they're regularly involved in buying and selling. But if they are, or they're not covered by the exclusion, then maybe they do need to run through and say, gee, do I need to register as a dealer? And so I think that's an important part of clarity here. And for this reason, we put out a proposal here, which I thought, we had a quantitative test, which I wasn't here at the time, but didn't quite make sense to me. But this is why we've had so many advisory committees, whether it was FIMSAC or MSAC, to try and work through these things, including additional questions like, hey, if we do bring them in as dealers, does the current dealer regulatory regime really work for these types? And to explore all that. So before we sort of jump off the diving board, we kind of know what's below us. And so I think, this would have been well served with some sort of reproposal to try and get things once, because it seemed like a lot of the comments were primarily focused on the quantitative aspect, which I appreciate, that we listened to it, but I just think there are a lot of other minor details here that need to be ironed out, and not necessarily we ought to wait for, well, we'll just do this as post-rule implementation guidance or FAQs or risk alerts or things like that. So thank you.
Thank you, Commissioner Whittick. Commissioner Lizarga.
Thank you, Chair Gensler. Thank you to the staff. While markets and financial regulators will face the uncertainty of unanticipated shocks, strengthened market resiliency can help reduce the harmful impact from these shocks. It can provide greater protection and confidence to investors, capital markets, and the financial system. Today, the Commission takes important steps to strengthen market resiliency by leveling the competitive playing field between and among market participants that act as dealers but have not registered as dealers. In a 2022 speech before the securities industry, U.S. Treasury Secretary Janet Yellen referred to the Treasury market as the bedrock of our financial system. Bedrock of our financial system. Secretary Yellen highlighted the need to enhance this market's resiliency in light of recent episodes of stress. In its 2023 annual report, the Interagency Financial Stability Oversight Council, known as FSOC, urged financial regulators to strengthen resiliency through enhanced data transparency. The Commission's reforms today move us towards this goal. In recent years, high-frequency trading firms that specialize in electronic and automated trading have achieved a significant share of trading in the Treasury market. Some unregistered firms trade in high volumes that are comparable to those of the most active registered firms. The net result is a Treasury market that is now split between registered firms that operate with transparency, adequate capitalization, and operational integrity, and unregistered firms with a significant presence in the market that don't. Registered firms provide the market with key data that make it easier to discern and assess market risks. These firms comply with applicable financial responsibility and risk management rules. And absent today's reforms, our capital markets and financial regulators would continue to lack key data and therefore limited oversight over an unregistered segment of the market. Dealer registration is designed to address the specific risks related to dealer activity and the associated risks to financial stability that may arise from the failure of a significant liquidity provider. These risks are real. The Treasury market has experienced numerous shocks over the last decade, including some involving unregistered firms. In the March 2020 dash for cash, certain unregistered firms pulled back from the market because they lacked the capital to continue providing liquidity. Had the rule we are considering today been in effect, these firms would have been registered and may have been less likely to leave the market. Unregistered firms are not subject to regulatory oversight nor commission examination of books and records, and they are not subject to commission or FINRA rules that address algorithmic trading risks. Associated persons of unregistered dealers are also not subject to FINRA's registration and qualification requirements. The fact that registered and unregistered entities performing substantially similar dealer functions are subject to such different standards makes the Treasury market less competitive and less transparent. The final rules will increase competition among firms that are engaged in similar dealer activity. Applying consistent regulation to these entities will promote market stability by increasing the financial responsibility and operational integrity of these currently unregistered firms. By requiring unregistered high-frequency trading firms to register as dealers, today's reforms provide for a standard that is more protective of investors in our markets. Both the Commission and all market participants will gain the benefit of increased visibility into and enhanced oversight of the trading activity of these significant market participants. Overall, today's reforms will enhance the Treasury market's resiliency and transparency, strengthening investor protection, and promoting financial stability. I am pleased to support these important reforms that in particular will benefit our country's vital $24 trillion Treasury market. Thanks. I have no questions.
Thank you, Commissioner Lizarga. With that, how do my fellow commissioners vote with regard to the staff's recommendation on the definition, I have to say the words properly, on as part, to further define the phrase as part of a regular business as used in the terms dealer and government securities dealer?
No.
Yes.
No.
Yes.
Yes, the ayes being 3-2, the matter passes. It will be sent off to the Federal Register, but also shortly, probably today, be on our website. I want to thank everybody again. I want to thank the various divisions represented here and an excellent conversation and discussion, but everybody who's been working on this from all across the agency. And of course, even though we didn't come to unanimous vote here, I thank my fellow commissioners for the feedback and input. Thank you. With that, the meeting is adjourned.